We're going to be starting our fourth topic or even fifth today. In our first class, we started with regulatory framework and ethics in reporting. In our second class, we started IFRS 2 on share-based payments. I think that took us like two classes. Then we moved on to IS 19 on employee benefits. That also took us two classes. Tonight, we will be looking at financial instruments. This will take us like three classes max, three classes max. So today, on Saturday, then maybe next week, Wednesday, then we'll round it up. Or I might decide that, okay, let's have class on Sunday, since that period seems to be very, very open, just for us to move as fast as we can. Okay, let's get to it immediately. So remember vividly that on employee benefits under IAS 19, the focus there was how to account for staff cost or any form of consideration that is given to an employee by an employer, of course. And in looking at these employee benefits, we looked at the categories of employee benefits from the short-term employee benefits to post-employment benefits. We mentioned briefly termination and other long-term benefits. The one you often find in your exam is post-employment benefits. That's the one you would find in your exam, not any of those other ones. However, we looked at short-term employee benefits, and the core of short-term employee benefit is not beyond saying that when do the obligation owe? Sorry, I say when does the entity has an obligation to pay this money? When do they have obligation? When that's the core thing in short-term employee benefit. When do they have an obligation to pay? And the organization really has an obligation to pay immediately the employees as they have worked. So at the end of every month for short-term employee benefits, whatever benefits the employee one must have worked for, we need to accrue for it. So you find us debiting staff costs and crediting accrued or accruals or accrued staff cost. However, there are some paid absences like leave allowance, sick allowance, something like that, where we might have accumulating or non-accumulating. And we mentioned that if it is accumulating, which means even if the employee does not take that benefit, they can carry it forward here. And I mentioned to you that for those for those type of benefit, the organization will need to make accruals for the benefit at the end of the year, since the employee would ultimately take it. However, in the exam, they will give you some estimate of how that should be worked out, especially what the employer might likely pay in subsequent years. And that would be what they would put in their books as a liability. But the one that is non-accumulating, that you might not even have to put it in your books at all unless the event occur. So it's only if the event occur, that is the take on that leave, that's when you find the organization having an obligation. Otherwise, nothing goes into our books. And also, if there is a profit share or bonus. And the criteria for that bonus has been met by the organization, that means they have an obligation to pay that bonus or profit sharing. So they would have to also recognize that as a liability, the books, and also as an expense by debiting staff costs and credits and accruals. I told you that that's relatively straightforward. But you see, the one that ICANN has consistently tested in your exam, as far as IAS 19 is concerned, is post-employment benefit, where the employee only gets benefits when the employee retires. So the way organizations do it is to start saving, because they know that the money will be huge and plenty. So they will start saving for that future obligation. So they have two options for these savings. We call it plan. There is a defined contribution plan and there's a defined benefits plan. The one that is a defined contribution plan is where the organization only makes contribution to a plan. And the responsibility to pay employee when they retire lies on that plan, which we call PFA in Nigeria. Usually in Nigeria, you're required to contribute 10% while the employee does 8%, so in total 18%. Of course, then they can do additional voluntary contribution if they want to, but ultimately, as far as we accountant is concerned, the substance of defined contribution plan is that the only obligation the organization has is to make regular contribution. They don't have any obligation beyond that. And in accounting for it, very straightforward. You just debit staff costs or pension expense and credit accruals when it is due date for payment. Whatever it is they have agreed to be paying, you need to accrue for it at the end of every month. And when they pay, of course, you net off the accruals. So it's very straightforward. But you see, the defined benefit plan, I told you that for that, the organization has made commitment of a lifetime. They have made a commitment of benefits to the employee. They have told the employee that you will get this social amount of benefit or this value of benefit when you retire. So in such scenario, the obligation the entity has is that benefit. So they would really need to then account for it to show that they have such an obligation. Now, of course, if I tell you that when you retire with me, I will give you 10 million. You know that if you don't retire with me, you won't get 10 million, of course, but you will get something, but not up to 10 million because you left before you retired, something like that. So, but ultimately, the way we account for it, the standard recommended a projected unit credit method where every year the employee is working for you, then you assume you owe him a benefit for that year. And the whole calculation of how to determine that benefit, the value of it today, and all of that is done by an actuary. So the actuary will give us an actuarial report that will contain the following. Number one, current service costs. Two, past service costs. Three, contribution. Four, benefits. Five, the fair value of the plan asset and the present value of the defined obligation. And of course, if there are curtailment, we gain a loss on settlement and all of that. We explain all of those in details. I gave you a schedule, we solved questions and all. And I can remember that last week we also looked at asset ceiling. Asset ceiling. And for asset ceiling, I told you that the main substance there, or the key principle there, is that when we have a net defined benefit asset or a surplus, that we need to restrict how much we recognize as that surplus to the amount of actual savings you are making. I mean, in accounting, when you say you have a surplus, when you say you have an asset, it means that you're expecting a benefit. What's that value that you have put in your books? And because of the very nature of this type of arrangement or benefits, the way it works is that you say you say you are owing people some amount of benefits, let's say 10 million, and you say you have saved so much, 12 million. So you have saved 12 million to net off the benefit you want to pay people of 10 million. So that means that 2 million, before you can put it in your books as an asset, it should really mean that it is an asset to you. That is, you're expecting future economic benefits. And that's what asset ceiling is talking about. That the 2 million, is it really savings? Let it reflect your savings. And the savings in this circumstance would be either reduction in future contribution. I mean, you have over contributed, so there should be a reduction in your future contribution, or there should be a refund from the plan. Okay, so we would be given that. Sometimes the examiner would describe it as asset ceiling, that okay, the asset ceiling is this amount. So we would expect that the amount that is recognized in your book as a surplus or as an asset should be that asset ceiling. It should never be above it. Any amount you have in your books over and above that amount should be recognized in OCI because it becomes a remeasurement. It becomes a remeasurement loss. You will take it to OCI straight on. We solved the question like that last week. So the one I won't really spend so much time on, at all, I will just is termination benefits and other long-term benefits. Why I'm not spending so much time on it is you hardly find it in your exam and relatively straightforward in the sense that I told you that the termination benefit is the one where the employee says, okay, give me benefits so I can leave your organization. I mean, I'm just saying it literally. So the way it happens is that probably the organization wants to relocate or leave the country or shut down abruptly. I mean, they just have to go. So they then give people benefits. They give people benefits. Yeah, there was a company, they had to, it's in the oil and gas industry. They divested their interest to an indigenous oil company. And when those staffs had to leave, they had to pay them some benefit. That's termination benefit. In fact, before then, they had been planning this for a very long time that, okay, oh, we are cutting costs too. And they have been laying people off. And what they were telling those people is that, I mean, you can choose to go. We would give you benefits. So those of them that keyed in, then that's termination benefit. So how do you then account for that? Pretty straightforward. Is when the event occur, there is no point where an organization will have an obligation to pay termination benefits. It's not as if they are planning to shut down or send people away. So it's only if those circumstances that are outside their control happen and they know that, okay, we are sending people away, then people that choose to go, of course, they will pay them. That is when they have an obligation to pay. And that's where they will debit staff costs and credit bank or a liability, as the case may be. But you see the other long-term benefits, that's very similar to what I've explained to you under defined benefit plan. So I can rather ask you defined benefit plan than to ask you other long-term benefits. Because for other long-term benefits too, paying those staff on until later into the future. So usually they also use actuary to work that out, but it's not common. You hardly find it. The way other long-term benefits are accounted for in reality is when they occur. I mean, things like, okay, if you work with us for 5 years, we'll give you a car. Nobody takes time to be measuring and doing all of that. What they basically do is that um, they will just wait until that event occur before they account for it. Okay, so that's by revision for the classes we have had before now. So I gave you some assignments. I showed you some questions. Uh, I showed you some questions and to solve. I don't know if any of you solved it. But what we'll try to do is if I might schedule a class with you guys on Sunday to solve past questions on all the topics you have done so far, including that of today, just to get you familiarized again with what we have done so far. Okay, so let's get to work for today. Now, today we are going to be looking at financial instruments. Financial instruments. And for financial instruments, we'll be using IFRS 9 that talks about financial instruments, let me say recognition and measurement, though it's more than that. We would also be using IAS 32 that talks about financial instruments disclosures. And there is IFRS 7, which I would not touch. Financial instruments, sorry, IAS 32 is financial instruments presentation. IFRS 7 is financial instruments disclosures. So these three standards would help us to understand financial instruments. But generally, before I move into the standards, the general idea I need you to have about financial instruments is they are majorly equity instruments and debt instruments. So substantially, when I say that I want to teach you financial instruments, what I typically want to teach you is basically how to account for equity instruments and debt instruments. When we say equity instruments, it is a tool that company use to raise money. When you want to raise capital for your business, you would issue an equity instrument, and whoever buys those equity instruments from you becomes your shareholders. So company use it to raise money, to raise capital. Equity instrument. Similarly, debt instrument is also used to raise money. But whoever buys these debt instruments becomes your creditor. Debt instrument. So when you want to borrow money, you issue debt instruments. When you need shareholders, you issue equity instruments. So how do you then account for that when you borrow money? How do you account for that? So you need to understand how to account for it from the standpoint of the person borrowing money and also from the standpoint of the person that is giving the money, both for a debt instrument and equity instrument. Equity instrument is where you need shareholders. You don't want to borrow money. You don't want to, you're not ready to pay back that principal. You want people that would go all the way with you into the future. Equity instrument. So you really need to understand how do we account for this, both from the standpoint of the issuer the entity or the individual that is borrowing the money or that is collecting the money in the case of equity instruments, and also the person or the entity that is giving the money. We need to understand both sides properly. And really, that is what we want to look at today. So, at a very simple or simplistic level, when I say financial instruments, I simply mean either equity instrument or debt instrument. Okay, so let's get to it immediately. For financial instruments, let's use IAS 32 first, that talks about financial instrument presentation. To understand what financial instrument is. So this IAS 32 talks about definitions that you need to know. It talks about how do you present, presentation, and classification of financial instruments into debts or equity instruments. And it also talks about offsetting. Also, it talks about compound financial instruments. Compound financial instruments. Okay, let me start with some definitions that you need to get familiar with. And the very first, of course, is financial instruments. I know I've done a general introduction of this, but the way IAS 32 defined financial instrument, it says that it is a contract. It is any contract that gives rise to financial assets of one entity and financial liability or equity instrument of another entity. Okay, this is how IAS 32 define financial instrument. It says it is any contract that gives rise to financial assets of one entity and financial liability or equity instruments of another entity. So the first thing here is that financial instrument is a contract, meaning there has to be a contract. And everyone here should have an idea of what a contract is. However you understand it, it is an agreement between two parties that has legal and economic consequences. In fact, that's what makes it a contract anyways. An agreement that has legal and economic consequences. Is that legal and economic consequence? That's the thing itself. That you know that if you don't do what you're supposed to do, somebody can sue you. You would have to pay some penalty. I mean, there are consequences to inactions or non-action, right? So, with that, we can then argue that a contract does not necessarily have to be in writing. It's just however you guys agree in your jurisdiction. Just agree, right? And it must have legal and economic consequences, which is the main thing there. Okay, so a financial instrument has to be a contract. You see, this contract in question, when we look at it, what we want to find there is that one entity must have financial assets. One entity having a financial asset and another entity having either a financial liability or equity instruments. So whenever we pick these contracts, when we look at it, there must be at least two parties. Let's call them Party A and Party B. These two parties, either of them, let's say Party A, must have what we call financial assets, which we're going to explain very soon. You see, Party B can either have financial liability or equity instruments. You see, this must occur before we can say, okay, this is a financial instrument contract. This thing I've just painted must happen. There has to be at least two parties. One party must have financial assets, and another party must have either financial liability or equity instrument. If that does not happen, then we don't have a financial instrument contract. And from the introduction I gave you, I told you that financial instrument is either equity instruments or debt instrument. Let me take debt instrument for example. A typical example from what I taught you, I told you that debt instrument is used to raise money, especially when you want to borrow money. And what are examples of debt instruments? Then we'll be talking about loan notes, debentures, commercial papers, you have treasury bills, you have bonds, and all of that. These are examples of debt instruments. So, you see, when you walk into the bank and tell the bank, oh, you want to borrow money, and the bank agreed and say, okay, I'll give you money. See, what has happened in there is that you have issued a debt instrument. Then the bank agreed and said, okay, I'll give you the money. Then the bank has bought or acquired your debt instrument. So in this case, you will see that there are two parties. You, that you want to borrow money, that you have issued a debt instrument. You that you want to borrow money, then you have a financial liability. You have a liability. You see, the bank that said, okay, I'll give you the money. The bank has a financial asset. I'll still go more in depth. Another example is the one that organizations use popularly nowadays is commercial paper. Commercial paper. So if you go to FMDQ, you will see a lot of commercial papers that are listed or corporate bonds. But commercial paper is more popular because of the interest rates being very low. So banks or companies, let's say Coleman or Dangote Cement, they'll say, okay, I need to borrow 50 billion naira through commercial paper. They'll go to FMDQ, they would request, FMDQ would approve, then they will list it. Now, when they list it, there will be a contract document that, okay, we want to borrow 50 billion, we will give you interest rate of 20%. You see, what Dangote is doing is they are saying that, okay, come and borrow me money. Come and borrow me money. So Dangote has a financial liability. You see, if people then buy it, meaning people give money to Dangote, that okay, take your money. So of course, they will pay the money back with interest. Those investors, they have financial assets. That's a financial instrument contract. That two party is complete. Or you don't want to borrow money, you need shareholders. So you go to the Nigerian Stock Exchange, or you don't want to go there, you want to do it through family and friends. You say, guys, I just started a business. I will need you to invest 100 million naira in my business. And at the end of every year, I give you dividend or we share profit. That's capital. You need shareholders. So what you're doing by inviting people to invest in your business, you are issuing equity instrument. So as far as your book is concerned, we call that equity instrument. So you have an equity instrument because that is share capital. You put it in your book as share capital. Of course, when they invest, when they give you that money, that okay, we believe in your vision, we believe in your drive, we believe in you, we're giving you this money. Those people that gave you money has a financial asset. You see, in all the scenarios I've given you, there are two parties. Of course, there is a contract. That instrument they issue is a contract. And this contract gives rise to financial assets of one entity, the person giving money, and financial liability or equity instrument of another entity. If you have followed me, you will see that is the issuer, is the person that wants to collect money that would either have a financial liability or equity. And if you have followed me, you would see that if that issuer wants to borrow money, that is when in his book he will say he has a financial liability. But if he needs shareholders, if he needs people that would take risk with him, then he would have equity instrument. IAS 32 went ahead and said that financial assets is any contract also that is cash, equity instruments of another entity, and contractual rights to receive cash or to exchange financial assets with another entity under conditions that are potentially favorable to the entity. Okay, let me stop here. The reality is that the definition even goes beyond this, but as far as your exams is concerned, let's get to work with this. So it says financial assets is any contract that is cash. So financial asset is cash. And when we say financial asset, it means cash. So when you have cash, either money in the bank or highly short-term investments, that is cash. Those are examples of cash. Cash does not really have any definition whatsoever because what is cash? Cash is cash. I mean, the only definition of cash that we have was in IAS 7, and it did not define cash. What IAS 7 defined was cash equivalent. Cash equivalent, cash and cash equivalent, where it says that it is a medium of exchange that is generally acceptable with an insignificant risk of changes in value. But the reality is this: cash is cash. Money in your bank, money in your hand, highly short-term investments, those are cash. Cash is cash. So, cash is a financial asset. Secondly, it is equity instrument of another entity. When you buy shares in another entity, when you hold equity instrument of another entity, you have a financial asset. In fact, it is an investor that can have a financial asset because when you buy shares in companies, that is you having equity instrument of another entity, and that is you having financial asset. So financial asset is equity instrument of another entity. That's financial asset. Financial asset is also contractual right to receive cash. When you have a contractual right to receive cash, that is a financial asset. And you need to understand that contractual right to receive cash is different from an opportunity to make money. Contractual right to receive cash means that you don't have to even lift a finger for that money to come because you have done the hard work in the past. The money has to come. You have a contractual right to receive that money. That money must come to you at a specified date. Otherwise, that counterparty will be in trouble. When you have contractual right to receive cash, the person must pay you. And typically, this will arise when you lend people money. When you lend people money, you automatically have a contractual right to receive cash. Or when you sell goods on credit, wherein you are now having a trade receivables in your book. Trade receivables in your books means you have right to receive cash. The customer must pay you. He has to pay. There's a contract. When you invest in government, they issue treasury bills almost every quarter. When you invest in such, you have a contractual right to receive cash. They must pay you back your money. They must pay you interest. It's a must, it's a contractual right. So what gives you contractual right to receive cash is when you lend people money, when you sell on credits, when you invest in a debt instrument. That is what gives you contractual right to receive cash. So, see, substantially, what I really need you to think and understand so very well is that anytime we mention financial assets, Just understand that that guy is an investor. I mean, that's the person that can have an asset anyway, an investor. So, and financial asset can be any of these three. Any of these three. Either cash, either you have cash, that's financial asset automatically, or you buy shares in another company, that's equity instrument of another entity, or you have right to receive cash, meaning you have invested in debt instrument. Now, when you understand that very well, then this one, you will be able to tinker this one out. I won't really emphasize so much on this today. It's a story for probably next week, or maybe along the line as we give more examples. But to read it out, it says, you also have financial assets. When you exchange financial assets, one financial asset with another, you exchange your financial assets with another under conditions that is favorable to you. You see, transactions like this happen when you are exchanging either your shares or your investment you have made, you exchange it with another entity for whatever reason and it's favorable to you. Then that is also a financial asset, but this is really not our focus for now. Again, financial liabilities or financial liability is a contractual obligation to deliver cash. A contractual obligation to deliver cash or to exchange financial assets with another entity under conditions that are potentially unfavorable to the entity. This one is also similar to the other one that you would get to understand better with examples as we move on. But the key thing about financial liability is that it is a contractual obligation to deliver cash. That is what you really need to think and understand very well first for you to be able to identify that, this is a financial liability. As soon as you see that there is a contractual obligation to deliver cash, is a financial liability. And if you remember, when I was teaching you share-based payment under cash settled, you will see that cash settled, the organization usually settle with cash, though the amount of cash is dependent on the share price, but they will still settle in cash. You will see that when we're accounting for it, when we debit staff costs, we credit liability. That liability we are crediting there is a financial liability because the organization has a contractual obligation to deliver cash. This is secondary. Might come back to this. That's not the focus for now. Again, financial assets, these three is cash, equity instrument of another entity, contractual right to receive cash. Understand that. So when you see a transaction, you say, this one is financial asset. Then you should be able to spot financial liability by first understanding that who has an obligation to deliver cash. then that party has a financial liability. And like I told you, this financial liability will arise anytime an entity issues a debt instrument. You automatically have financial liability. When you issue a debt instrument, when you are borrowing money, financial asset is you are an investor. The third one, which is equity instruments, and this is typically when an entity issues share capital, especially ordinary share capital. That's when the entity has an equity instrument. When you need shareholders. You see, from this analysis I've given by IAS32, you need to understand clearly that PPE, for example, property, plant, and equipment, or an intangible asset, an organization that is having a plant that they are using to produce goods in the factory, or they have a motor vehicle that they are using to do delivery, and they are making money from them. You need to understand that those type of assets are not financial assets. They are not. Even though, yes, you can make money from them, they are not cash. They are not equity instrument of another entity. Neither do they give you a contractual right to receive cash. They don't. They only give you an opportunity to generate cash. If you use that asset properly, you will make money. If you don't use it, you won't make money. But financial assets, you don't have to do anything. You will make money before you would say you have a contractual right to receive cash. So those ones can never be a financial asset. Okay, this is the first part of IAS32 or financial instruments. I've said a lot and I can't just run over it. Is a major part of what you would find in your exams. The examiner wanting to be sure that you understand deeply financial assets, financial liability, and equity. So let's go through some examples with you, just to be sure that you have understood this before we move into anything else. Okay, so let's start with this. Do I have Ahmed in this class? Is Ahmed here today?
Yes, sir. Good evening, sir.
Oh, Ahmed, how you doing?
I'm fine, sir.
Okay. Do what you do best in this class. Ahmed, we can't hear you. Ahmed, you're muted. We don't have time. Let another person wait, please.
Okay. Can I read now?
Yes, please.
Yeah, okay. The following question relates to Networth PLC for the year ended 31st December 2021. A. Networth owns cash of 5,000 naira. B. Networth owns a demand deposit of 1 million naira with First Bank. C. Networth's statement of financial position includes 2.5 million naira shares of Google Incorporated. D. Networth statement of financial position includes inventory of 56,000 naira. E. Networth sold goods amounting to 55,000 naira to Lai Limited on credits. F. On December 2021, net worth received an advance payment of 250,000 naira from one of its customers, Muri Limited, to deliver goods in January 2022. G. Net worth statement of financial position includes a current tax liability of 5,000 naira as well as a deferred tax liability of 6,500 naira. H. Net worth purchased a Bitcoin of 5.5 million naira. Required. Determine whether the items above are financial assets or financial liabilities, and also states whether a financial instrument exists as at 31st December 2021.
Thank you very much.
Welcome,
It
sir.
says, if you look at the requirement of this question, it says determine whether the item above are financial assets or financial liabilities, and also state whether a financial instrument exists as at the year end. So this question is not a single question, it is two in one. There are two questions here. So that means the first thing you need to do is you need to look at net worth, because the entity in question now is net worth. You need to look at net worth and see, do net worth has financial assets or financial liabilities? You now also state, after you have determined what net worth has, you now also state that, is there a financial instrument contract here? Does a financial instrument exist here? Okay, so let's pick it one by one. So I would do the first one. Anybody can do the next one. So let me start with the first one. The first one says that net worth owns cash of 5,000. So my own answer is that net worth has a financial asset, because cash is a financial asset from the definition of a financial asset. And in this case, there is no financial instrument here. There is no financial instrument here because, yes, net worth has a financial asset, but there is no other party that has either a financial liability or equity. For that reason, there is no financial instrument that exists here. Because for financial instruments to exist, one party must have financial assets. Yes, you have identified that. But another party must have either financial liability or equity. But in this case, there is no such here. Okay, so no financial instruments exist. That's my answer. Okay. Can anyone do the B? Can you do a similar analysis for B?
The network owns the demand deposit of 1 million in First Bank. That is he owns a financial asset in First Bank. First Bank, that's a financial instrument exists because he has another entity. Another entity is involved in this instrument. And there's a financial instrument. That's the back for B. I think demand deposit is a financial asset. Financial asset because that's that.
Okay. You have done very well, and you're correct. Yes, net worth has a financial asset, because when you look at demand deposits, it's just like it's similar to your fixed deposits, similar to that, or you depositing money in the bank. That's a financial asset. Anytime you want to collect it, you collect it. It's like having a contractual right to receive cash. That's a financial asset. So net worth has a financial asset. And here, because there is another party, which is First Bank here. that has a financial liability because they have obligation to deliver cash to you. Anytime you want, they have to, it's compulsory, they have to. So that two-party is present, where one party has financial assets and another has financial liability. So it's present. Nice one, Christopher. So who can try the third one?
Okay, let me try.
Okay.
Okay, for the third one, said net worth statement of financial position includes 2.5 million naira shares of Google Incorporated. I think financial instrument exists because net worth has 2.5 million naira in shares. That 2.5 million is in financial assets to net worth. Why the 2.5 million, the 2.5 million also is a financial liability to Google Incorporated. And for that shares that have been allotted to Net Worth Limited, they will also have a share certificate issued to them. So, okay.
Okay.
The proposal instrument for Google.
Sorry, what do you say, Christopher?
It's an equity,
Okay.
equity instrument.
Thank you very much, Christopher.
Okay.
Yeah, that's correct. So every other thing he has said is correct. Yes, he is right. Net worth has a financial asset. That's equity instrument of another entity. He has a financial asset. And there is a financial instrument exists here because there's another party, Google, that has an equity instrument. That was where he got it right. He got it wrong. He said Google has a financial liability. No, Google doesn't have a financial liability. Google has an equity because I explained this one before that when you are raising money, now you need shareholders. That is equity instrument. So Google has an equity instrument. So it's very important you don't miss that again. Okay, who wants to try this, the fourth one?
Mm.
Let me
Net worth.
try.
Okay, go ahead, Augusta.
I think this is a financial aspect, and there is no like if there's no like super it's not property involved in it. Like it's just single, it's just one. Like an inventory which amounts to asset. Like when you come to your current asset, your financial position. So that's it.
Thank you very much, Augusta. So you said net worth has a financial asset and there is no other party, so there is no financial instrument that exists. Yes, there is no financial instrument exists, but net worth does not have a financial asset.
It's a financial liability.
Inventory, no, it's not a financial liability. When you have inventory, yes, inventory is an asset. Yes, it's an asset, but it's not a financial asset because inventory is not cash. Inventory is not cash. Inventory is not equity instrument of another entity. Inventory does not give you contractual right to receive cash. Does not give you contractual right to receive cash. So, and if it is not falling in any of those three, that means it's not a financial asset. I mean, some people might want to argue that shebi is inventory, you have right to receive cash now. No problem now. Go and buy goods and start selling and see how easy it is to sell. Then you understand that me having an inventory does not mean you have a right to receive cash. Because the effort you go through in making sales, I mean, marketing people are trying, it's a lot of effort. So, and I've told you that when we say contractual right to receive cash, it simply means that you don't have to lift a finger, you don't have to do anything. at a specific date you would get money. And the only thing that can give you that is when you'd borrow people money, you lend people money, or when you have actually sold on credit, that you now have a trade receivables, then that's when you can say, okay, you have right to receive cash. Not when you have not sold, it's still inventory. So inventory is inventory according to IAS 2. It is not a financial asset. Please put that in your accounting dictionary so that you can do well in applying them. Okay, who can try the next one?
The financial liability.
Two.
So,
Okay, net worth has a financial liability. Is that what you're saying?
and there's an financial issue because it's so good with credit.
I think it's a financial asset
Okay.
because network has a contractual right to receive this cash of
Okay.
55,000 for the goods sold to Lai Limited.
Yes. So is there a financial instrument here?
There is, sir.
No,
Yeah, there is, of course. There is. Okay,
There
so yeah. So
Oh,
net worth has a financial asset too. Net worth has a financial asset because it's sold on credits. That is a trade receivables.
Yes.
So he has a right to receive cash. And there is now another party called Lai Limited that has an obligation to deliver cash, which is a financial liability. So that two party exists. That two party exists. So there is a financial instrument. So net worth has a financial asset and there is a financial instrument. I mean, I have a lot of students here. Very few are participating. Well, everybody has their own strategy. So who wants to try the next one?
Okay, sir. I would like to try, sir.
Go ahead, Michael.
Yeah, the next one, on December 2021, Networks received an advance payment of 50,000 from one of his customers, Muri, now to deliver goods in January 2022. Yeah, we have a financial instrument in this, sir, because we have a contract. Okay, you have received 250,000, I mean, in December to deliver goods in January, sir. So we have a contractual distance agreement. So is that okay, sir?
Okay, yeah, it's okay. You have tried. So,
can I add more?
hmm?
Or I think you answered it correctly. I'm looking at it that it's
Say,
a financial liability on network part to deliver these goods to the customer, Muri Limited.
Okay, no problem. You have also tried. You have both tried, but you are still missing out the key points. You will have gotten it right because you said net worth has a financial liability because it has obligation to deliver goods. But remember, I told you that financial liability is an obligation to deliver cash, not goods. When you have an obligation to deliver goods, that is not a financial liability. The focus of financial liability is obligation to deliver cash. So when they tell you that net worth received an advance payment, he has collected money from one of his customer, Mori, to deliver goods. To deliver goods. So when you have an obligation to deliver goods, that is not a financial liability. According to IFRS 15, that is a contract liability. When you have to, when you collect money, according to IFRS 15, you cannot recognize that money as sales. You cannot say you have sold because You collected money, you have not done the work. You have not worked, you collected money. It's just like us now at Equity Professionals. Some of you that has paid fully, you know that we cannot recognize the entire amount as revenue yet. We would have a portion of that amount that would recognize as a contract liability because we have not fully delivered the service. So when we have an obligation to deliver a service, that's a contract liability. It is not a financial liability. So I really need you to have this. If this is the only thing you learn today, like I'm okay, that financial liability is a contractual obligation to deliver cash. Every word there is important. Contractual. In fact, if there is no contract, that one too negates it. It is not a financial liability. There has to be contract. A contractual obligation to deliver cash. Cash. I mean, know that first. So in this case now, right, net worth only has an obligation to deliver goods. So it doesn't have any financial liability here. It has a contract liability. And Muri Limited also is expecting service. He's not expecting cash. He's expecting service. So there is no financial instrument here at all. Because we don't have financial liability, with the other party is not a financial liability. So it's not complete. Anytime one of them is missing, then forget it. So that's the case of this one. Let's see with that knowledge now. Let's see if anybody can try this next one.
Sir, sorry. This next one, sir, is talking about tax liability, sir. I'm having instinct according to the answer, but I'm not sure. So I would like you, if you can explain to us, sir. But other person can try, sir, please. So sorry.
I thought you were going to try anyways, but
Hello, sir.
surprisingly,
Good
you
evening.
didn't try.
Hello, sir.
Yes, go
Hello,
ahead, please.
good evening.
Good
Yeah,
evening.
I
this
think
other
it's
one.
a financial liability. I don't say financial instrument.
Okay.
So
Okay.
there's no financial instrument does not exist in this does not exist because it said in that it's a financial policy include the current tax liability of five as well as debt tax onto the two entities. So
The government.
it's just the internal okay the government.
Yes.
I think they have like internal expenses. So I
No.
don't
So
think
taxes are owed to the government.
Sir,
government yet
the tax are the financial asset to the government.
government. It's
Is that
all
your
those.
answer?
Hello, sir.
Man,
Hello, sir.
Yes, Michael.
Yes, sir. The tax we are to pay
Yes.
it is according to the law. You
Yes.
understand?
Yes.
Which I think we have a financial obligation to pay.
Yes.
Then the government who want to receive.
Yes.
It's not like it's contractual. This is why I told you I have instinct. I don't know how to express it, but it's not like it's contractual. I mean contractual, but it is just that it is according to the law of the land. We have to pay the tax. So
Okay.
I don't know if
So
it,
But I feel it is contractual in the
Sir,
sense
I
that
think the law is
have
the
to make a
contract.
consequence.
a contract.
okay.
Right.
Okay. All right. Okay. So let me start with Michael, right?
Yes, sir.
So let me start with Michael, right? So Michael, this is the final ICANN paper, and to pass any of these papers with flying colors is not just about learning all these principles and all of that. You might get to the exam and see a very entirely new thing. Always follow your instincts. And anytime you have an instinct, write it. Don't write it. Don't say, I'm not sure. Express it. If it's the way you have, because what you told me, surprisingly, I just really have to say this, that because you were correct, actually, your instinct was right, right? But the way you said it, say, I'm not sure, okay, me, I should answer it. No, you need to develop that habit from now, because 14 weeks is not far again. It's getting closer every day. Express it, okay? Because you were right. Now, another thing is this. Can you express it? Let me see if I can convince, like, hey, the man, and the other guys that think that there is a contractual obligation here. Yes, Michael is right. There's no contract here. Yes, you need to pay tax. Is your civic obligation, is your civic responsibility, is something you need to do as a citizen. But you do not have a contract with the government. Yes, there is a law of the land that says that individual and companies have to pay tax, being a responsible corporate citizen and individual citizen of an organization. That does not mean that we have a contract with the government. If there's anything close to that we have with the government, is the government that has a social contract with us to provide amenities, to provide housing, to provide infrastructures for us. For businesses and individuals, we don't have a contractual obligation. Yes, we know that generally as citizens, if you don't pay your taxes, the government can come after you. It's not because I have a contract with them. In this case, that's the nature of taxes. It's something you have to do. It's not like you willingly enter into a contract. The way contract is in law is something you have no choice. A contract, you have a choice. Like, okay, I want to agree. It's an agreement. A contract is an agree. This one is not agreement. It's just since the day you were born, you have to start paying taxes, because as soon as you start drinking food, there is VAT element on. Of course, yeah, baby food items exempted, but I mean, there will be some luxury items that you buy that that is VAT involved. But the point is that for taxes, the only reason, yes, you have obligation to pay cash, but it's not contractual. For that reason, net worth does not have a financial liability. Current tax liability is not a financial liability. Deferred tax liability is not a financial liability. So current tax is current tax according to IAS 12. Deferred tax liability is deferred tax liability according to IAS 12. They are not financial liability, because the only reason is because I don't have contract with the government. I hope I've been able to
Hello,
convince
sir.
you.
Sir, please,
Yeah.
sorry, come again. My network got sorry.
Yeah. So sorry too. I will come again, but it can't be with that zeal that I actually explained it initially. So when you'd have current tax liability, it's a liability, yes. You have an obligation to pay, yes. But this obligation is not a contractual obligation. You don't have contract with the government as far as taxes is concerned. Is a responsibility, is your civil responsibility. A contract is an agreement. For you to say there is a contract, you must have agreed willingly with somebody to enter into that arrangement. But for taxes, it is a compulsory levy. It's not about agreement. Whether you agree or you don't agree, nobody cares about your agreement. As soon as you start a business, as soon as you buy, you execute transactions, as soon as just enter into a taxable arrangement, you would pay tax. You have to pay tax. If you don't pay, the law requires that they come after you, not because you have a contract with them, but because you are a citizen, you're a resident of the nation. So, current tax liability is current tax liability according to IAS 12. It is not a financial liability. Deferred tax liability is deferred tax liability according to IAS 12. It is not a financial liability because they are not contractual. It is not a contractual obligation. I don't have contract with the government. Okay, I hope I've convinced you and not confused you. I hope so. Who can attempt this last one?
Okay, let me try, sir.
Okay, Michael.
Now, network purchased a Bitcoin of 5.5. Now, no contractual agreement, sir. It's like I go outside and buy bread. I buy bread, I come back inside. So I don't have an agreement with this thing of the bread, sir. This seller of the bread. So, sir, no contractual no contractual agreement, sir. So no obligation, sir. It is not a financial instrument, sir.
Okay.
But Bitcoin is an asset now, is it not?
It's neither a financial instrument nor a financial liability.
Okay. But Sarah is saying something that Bitcoin is an asset. Yes, so it's not even around the financial liability at all. It has nothing to do with liability here. Nothing to do with liability here. Because net
It's a
worth,
financial asset, sir.
It's not measurable.
I mean, that's now the question we should then ask. It's not a liability here. So the key question here is about assets. But the key question you need to ask that, okay, this asset, is it a financial asset? Is Bitcoin a financial asset? When you buy Bitcoin, and I'm sure that most of you should know what Bitcoin is. It's quite popular. It's just a type of cryptocurrency, and it's gaining a lot of momentum, right? So I think in 2019 or 2020, ICANN has asked this particular question, just this one. They have asked it in a diet for, I think, 15 marks, or I can't remember, just this one like that. That question is in this handout that you have. So the first solution is that Bitcoin is not a financial asset. Yes, Bitcoin is an asset, but it is not a financial asset because it doesn't check any of those check boxes. It doesn't check cash. Bitcoin is not cash. I mean, some people will argue that, no, it is cash now. We can use it to buy something. Yes, but according to IS 7, cash is a medium of exchange that is generally acceptable. Bitcoin is not generally acceptable. And IS 7 went further to say that anything called cash must have an insignificant risk of changes in value. It's not something that would fluctuate heavily like Bitcoin. You could hear today that Bitcoin is $10,000. You wake up tomorrow and you hear that it's 20,000. Overnight it's 20,000 from 10 to 20. That's a significant risk of changes in value. So cash should not change value like that, right? So Bitcoin is not cash. Bitcoin is not shares. When you buy Bitcoin, you're not buying shares in any company. It's just a currency, a digital currency. Bitcoin does not give you right to receive cash. When you buy Bitcoin, if you need your money back, you need to sell it. Anything you have to sell to get your money back, and you make effort to sell, is not right to receive cash. Right to receive cash means that you get cash without even talking. They must pay you at a specific date. That cash must drop. So Bitcoin is not a financial asset. It's far from it. So as soon as that is out, then that means there is no financial instrument contract here. There's no financial asset here. There's no financial asset. Okay. So this is the first part of financial instruments. You see, all these things we are just discussing, I'm intentionally asking you to contribute. I know what I'm doing is a major part of your exam. You need to understand this part very well. And I'm going to give you assignment to go and attempt. You need to understand this part very well. Okay, so that's the end of this question. Let's
Okay,
solve one.
please, that number E. Sorry to cut you. Please, that number E. What was the answer?
Network has a financial
Network
asset.
sold.
Yes, they sold goods to July. So that's trade receivables. That's a financial asset.
Okay.
Yeah, and there is a financial instrument here. Okay, any other question? Okay, if you don't have a question, I think I expected you to ask something, but since nobody's asking, that means you know it. So let me just ask you. So we said that Bitcoin is not a financial asset, Abi. So what class of asset is Bitcoin? Because that was the question for that diet. That they gave a case study and all of that. They were now asking that how should this company classify these assets in its books? So
Right.
Bitcoin, how are we going to classify it? What class of assets is Bitcoin?
Intangible.
Sir, are you talking about this is a current asset, sir?
Intangible.
It could be, I don't know. I don't know. It's a question. If you think it's current asset, it's fine. But I can hear somebody says an intangible asset. Yes, that's correct. Bitcoin can be an intangible asset. It is an intangible asset because,
Okay.
yeah, I studied it.
Okay.
Yeah. Is a non-monetary asset is an identifiable non-monetary asset without physical substance. And Bitcoin can also be an inventory, especially for those companies that sell it. So it is an inventory to those ones. So depending on what you're doing with it, but not a financial asset. So if you are seeing it as an inventory, then of course, Michael, that would be current assets. But if you are seeing it as an intangible asset, that would be non-current asset. Okay. So I'll put this in your workbook. I'll put assignments in the sense that since we were just discussing it, I was not writing the solution. I would really want to send you the solution. So let's take it as assignments. So I will expect you to write something down, send it to me, I send you the solution. Okay. Let's solve this one, then I will release you guys. When I release you, when I send this to you, this is going to be another assignment for you to attempt. Then next class, we'll move to these other ones. That's recognition and derecognition. Okay, so let's somebody read this. Aqua Nigeria. Who is going to read for us?
Can I read?
Yes, please.
Okay. Aqua Nigeria Limited is a private limited company planning to be registered with the Nigerian Exchange Limited. The company is engaged in the conversion of petrol engine into compressed gas engine. The following are the transactions of the company in respect of its debt and equity instruments. Transaction 1. Aqua Nigeria Limited issued 40 million non-redeemable one naira preference share as par value. Under the terms relating to the preference shares, the dividend is payable on the preference shares only if Aqua Nigeria Limited also pays a dividend on its ordinary shares for the same period. Transaction 2. Aqua Nigeria Limited entered into a contract with a supplier to buy a significant item of equipment under the terms of the agreement. Under the terms of the agreement, the supplier will receive ordinary shares with an equivalent value of 5 billion naira 1 year after the equipment is delivered. Transaction 3. The directors of Aqua Nigeria Limited, on becoming director, are required to invest a fixed agreed sum of money in a special class of 1 naira ordinary shares that only directors hold. Dividend payments on the shares are discretionary and are ratified at the annual general meeting of the company. When a director's service contract expires, Aqua Nigeria Limited is required to repurchase the shares at their nominal value. A senior accountant in your company, Aqua Nigeria Limited, has asked for your advice on how the above transaction should be treated in the financial statement of your company in accordance with IAS 32, Financial Instrument. Required, write a memo on the above request, discussing and justifying how each of the transactions should be treated in the financial statement in accordance with IAS 32, Financial Instrument. That's all.
Thank you very much. So this question says, write a memo on the above request, discussing and justifying how each of the transactions should be treated in the financial statements in accordance with IAS 32. Okay, so this is a past question. So when they say write a memo in the exam, that means you will need to do something like from maybe you're the accountant to did they tell us who you are? Aqua to be registered, the company engaged in a conversation of petrol engine into the following transaction of the company is in respect of write a memo. Okay, they didn't say from whoever. So
Oh, it was said that a senior accountant in your company has asked for your advice. Look
okay.
at towards the last line. Yes, you are there, sir. A senior accountant in your company has asked for your advice. So you are writing to the senior accountant, sir. As you, sir, you are this junior accountant.
Me, I'm not junior accountant. You are junior accountant.
For this period, sir.
Okay. Okay, so subject, something like this. So this request discussing and justifying how each transaction should be treated in the financial statement. So treatment of transactions in the financial statements in accordance with IAS 32 financial estimate presentation. Okay. All right. In respect the subject matter. Thoroughly thoroughly reviewed the transactions. You thoroughly reviewed the transactions. The following paragraph explains the treatment of the transactions. Okay, so I'm just trying to, you can flex around with these however you want, right? So I'm just showing you the templates and all of that. So this is the way you start. You do some like an introduction, then you then start picking those transactions one by one. You can start transaction 1, you do your analysis, transaction 2, you do your analysis, transaction 3. I mean, those will be your heading. Then you then do your conclusion. You just talk around that. Then you do yours. I mean, yours faithfully, not necessarily is internal. So thank you. Well, was you. Like I said, I'm a junior accountant, so junior accountant. Then I sign, maybe. Okay, that's just how memo looks like. We'll still talk about report writing. I think I would, for those of you doing case study, we are still going to do a lot of report writing in case study together. To be very fun when we get to that bridge. Okay, so let's pick these transactions one by one. We'll see the treatments. The first one says Aqua Nigeria Limited issued 40 million non-redeemable 1 naira preference shares at par value under the terms relating to the preference shares. A dividend is payable on the preference shares only if Aqua Nigeria Limited also pays a dividend on its ordinary shares for the same period. Okay, I would answer this, and I would open this one to you guys while we discuss it like we used to do. So now, for this one, it says Aqua Nigeria Limited issued 40 million non-redeemable preference shares or 1 naira preference shares under the terms relating to the preference shares. A dividend is payable on the preference shares only if Aqua Nigeria Limited also pays a dividend on its ordinary shares. Okay, let me break it down, right, for the examiner. So Aqua Limited issued 40 million non-redeemable preference shares. So first is this. Non-redeemable preference shares are instruments where the entity or the issuer has no obligation to pay back the principal amount invested. This is similar to ordinary shares. Therefore, from this perspective, it is an equity instrument. Okay, if we are looking at it from the principal perspective, because when we say non-redeemable, it means it will never be redeemed. I'm never giving you back that money. The best you can get is dividend or interest. If the examiner had said redeemable, preference shares, it means that I will give you back your money. Whether in the next 1 or 2 years, I'm giving you back your principal. So that one is a financial liability, because in that wise, it means that the entity has an obligation to deliver cash. But in this case, where they say that it's a non-redeemable preference shares, it means the entity or the issuer has no obligation to pay back the principal. So it is similar to ordinary shares. So therefore, from this perspective, it is an equity instrument. However, since dividend is only payable on these preference shares, dividend is payable on the preference shares only if Aqua Limited pays dividend to its ordinary shares. Since dividend is only paid to the preference shareholders only when the ordinary shares receives dividend. This further shows that the entity has discretion, or the entity can decide whether or not to pay dividend. Therefore, they don't have, or the entity, let me just say, they don't have an obligation to deliver cash. So from the standpoint of dividend payments, the non-redeemable preference shares is an equity instrument. Okay, so that's the solution to this. So the dividend will be treated as a deduction from retained earnings in the statement of changes in equity. Okay, if you are sleeping, you're wrong. Let's go to transaction 2. Transaction 2 says that Aqua Limited entered into a contract with a supplier to buy a significant item of equipment. Under the terms of the agreement, the supplier will receive ordinary shares with an equivalent value of 5 million 1 year after the equipment is delivered. So how do we treat this in line with, should we treat this in line with IAS 32? Okay, I think you guys are tired, so let me just...
Sir.
Okay, Michael.
Yes, I can see the word contract, sir. So with the word contract, it means it's a financial instrument, and it also has a financial asset, element of financial asset and element of financial liabilities.
Okay, no problem. That's a good trial. Let me break it further down for you. So if you look at it, yes, he entered into a contract. So there is a contract, that's fine, with a supplier to buy equipment. Under the terms of the agreement, the supplier will receive ordinary shares with an equivalent value of 5 million 1 year after the equipment is delivered. Now, let's systematically analyze this step by step. So the first thing here is this. The supplier bought an equipment. That should be a PPE in our books, right? We bought an equipment. So we are debiting PPE. However, how did we pay? How did we pay? We paid with our shares. You say under the terms of the agreement, the supplier will receive ordinary shares. This shows that Aqua Nigeria Limited is doing a share-based payment. Is receiving assets, and the consideration is given for that asset would be his shares. And the shares he will be given will have a value of 5 million 1 year after the equipment is delivered. So he's not paying now, right? He's not going to pay now. He's going to pay with that shares. He's not even paying cash. He will pay with shares 1 year later. So the key question here is this. We know that this guy has acquired assets, so he debits PPE. What we need to solve, the puzzle here, is what is he going to credit? And let me remind you, I taught you IFRS 2, but this does not qualify under IFRS 2 because we cannot say this is equity settled, and we cannot say this is cash settled because he's not even giving cash anyway. He's giving his share, so he has nothing to do with cash settled. It looks like an equity settled share-based payment, but here it is not, because the value of these shares is the value they are using is based on another value, not the value of the shares, but not even the value of the assets, but an independent value of 5 million. So the key question is this. That is even by the way. Will the credit be a financial liability or an equity instrument? That's the key question here. Now, it is clearly from what I've taught you so far, we can easily argue that it is equity instrument because we are issuing shares. Because Aqua Limited will give what? Shares. And I taught you clearly that that is equity instrument. But the challenge we have here is this. When we say we are issuing shares, how many shares are we issuing? What is the value of that shares? Now, before you can recognize an item as share capital, we must know how many shares we are issuing. In this case, we don't know until 1 year later. We don't know because they said the shares we are going to issue will have a value of 5 million, which means that the number of shares we will issue, we don't know. Is a variable number of shares in the sense that it will fluctuate depending on our share price, which means that if our share price is 10 naira today, it means that if we're supposed to settle or issue these shares today, that means we'll be issuing like 500,000 shares. If in 1 year time our share price goes to 20 naira, that means the number of shares we issue will change to 250,000 shares. So for that reason, because of that variability in shares, IS32 says that when an entity is issuing a variable number of shares, you cannot credit equity. I mean, I don't know how to explain this to you, but indirectly, there is an exposure. There is an obligation for us when you are issuing a variable number of shares. The standard says that you should treat that as a financial liability because the number of shares is not fixed. It's not fixed. They said we will give number of shares worth 5 million in 1 year time. I mean, that means the number of shares we want to give is a variable number of shares. Anytime you see that, that is a financial liability. Anytime you see that. So before you can say something is equity, that yes, we are issuing shares, be sure that if the number of shares we are issuing is fixed, we need to know how many shares we are issuing, not the one that we are not sure, that it depends on the value. No, 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 no. So as far as this transaction 2 is concerned, the treatment is as far as because this 5 million, we are going to pay it with shares in 1 year's time, 1 year after equipment is delivered. So the way we're going to recognize in our books is we're going to debit PPE and we're going to credit a financial liability. Are we going to do that with 5 million? No. We will need to discount the 5 million to present value because this 5 million is a future value. And in accounting, any payment that goes beyond 1 year, if you want to recognize it in your books, you need to discount it to present value. So we need to get the present value of this 5 million. And that's what we're going to recognize in our books. That's the answer to this. I really need to...
if the shares were given, does that make it any less a liability?
If they give us the number of shares.
Yes.
And that's equity now. That's clearly equity. That's the whole, that's everything I've been talking about since. That if they give us the number of shares, if number of shares is fixed, that's equity. The only reason why this one is liability here is the fact that we don't know the number of shares. In fact, the number of shares is variable because it's dependent on the value. So it's with an equivalent value of 5 million. So how many shares are we giving out? We don't know. It depends on the share price, so which varies.
Oh,
That reason is financial liability.
that's got down. Wait. Okay.
Of course, we have all the time to carefully look at it again, watch the video and all of that. Nothing has scattered here. We haven't said much at all. When the shares are variable, when we don't know how many shares we are issuing, it's financial liability.
I
That's
thought
just it.
I thought this whole thing is about what you are receiving, not what you are giving.
Anyway,
So
you are receiving assets.
you are
So
receiving
you
an
have
asset,
paid that.
you are giving shares. That is
Yeah.
a liability to you. Okay, it's an asset actually. But it's a liability because you are paying. Okay.
Yeah, so it's a complete treatment the examiner wants from you. So yes, the other leg, you are collecting an asset. So that one, assets, debit. So what are you crediting? Is it a liability or equity? And that's what I've been explaining since. That it looks like equity because we are giving shares. But when we look closely, we saw that the number of shares we are issuing is variable. Then automatically it becomes a liability. So it's a financial liability also to the entity. Accounting is two entries now, debit, credit. So assets, then financial liability. And also, because this 5 million is in 1 year time, whatever you are recording in your books today is at present value. You need to discount it to present value. The third one, it says the transactions or the directors of Aqua Nigeria Limited on becoming director are required to invest a fixed agreed sum of money in a special class of ordinary shares that only directors hold. Dividend payments on the shares are discretionary and are ratified at the annual general meeting of the company. When a director's service contract expires, Aqua Nigeria is required to repurchase the shares at their nominal value. Okay, so this is transaction 3 again. At least you're having a feel of how your exams looks like. And the reality is even that your own is even should be more technical than this because this is a skills question. This is skills. So yours will be more twisted than this one. But at least something like this anyways. So the directors of Aqua Nigeria Limited on becoming director are required to invest a fixed agreed sum of money in a special class of ordinary shares that only directors hold. Dividends payments on the shares are discretionary and are ratified at AGM of the company. When a director's service contract expires, Aqua Nigeria Limited is required to repurchase the shares at their nominal value. So the entire story here is that when like the directors of this company, when they become director, they're supposed to buy shares of the company. Okay. And it's this class of shares, only director that hold it. And payment of dividend is not automatic, is at the discretion of is discretionary, and it has to be ratified at the AGM. So, and when the director's contract expire, the company will buy back the shares from them because it's only directors that can hold this class of shares. So how do you treat this?
Okay, so can I try, sir?
Yes, please.
Yeah, I believe this has an element of financial asset because the directors, if they buy the shares in their own hand, it will become a financial asset. Also, it has an element of financial liability or equity, equity instrument in the hand of the company. So it also has an element of a financial instrument. So it is a financial instrument, sir.
Okay, good. So the company now, which is our focus, how is he going to treat this in his books? That's the question.
Okay, the company will debit. No. It will credit his shares, ordinary share cap. Abi. So, please let me think, sir.
Okay, so in the exam, you don't have to say you will debit this with credit. We just need some form of explanation so that you not mix things up. Yeah, just explain to us the principle and all. So the principle here is this, right? So the company issues their shares to these directors, And when the director leaves, the company would buy the shares back, meaning that the company will give them back their money, then collect back their shares, something like that. So ultimately, you know that their directors, they have to leave. There's nothing here that says that as soon as you become director, you die there. No. Every director their service would expire, as we are told in this question. So automatically, because of this, Aqua Nigeria Limited would have to report. It's something they will have to do. They will have to repurchase. If this last paragraph wasn't there, okay, these shares is you will have treated it as equity instruments in their books, because that's share capital now, because the directors are buying shares from the company. So the company is issuing shares. That's share capital. But in this case now, since Aqua Nigeria Limited will have to buy this share back, they will need to repurchase it from the directors, which ultimately means that the Aqua Nigeria Limited will have to deliver cash. They will need to pay those directors money, because that's the end. That's what will ultimately happen. The company has to pay money. Therefore, these shares will be treated as a financial liability. These ordinary shares they are issuing, this special class of ordinary shares, will be treated as a financial liability, because Aqua Nigeria Limited has an obligation to deliver cash, because they have to repurchase those shares back when the directors retire. So we cannot treat these shares as equity. Rather, to be treated as a financial liability. That's the answer. That's the answer. And any dividend payment, of course, since it's a financial liability, any dividend they pay those directors while they are holding these shares will be treated as a finance cost in P&L. Will be treated as a finance cost in P&L. Okay. So you need to look at these questions again. Try to write something down. You see that I didn't write the answers to these two. I have the answers with me that I can share with you. But these things requires you to sit down, think, get used to it, and know what we're talking about here. There's another question here. I have like how many? 9. You really need to practice this also, all these 9 questions. He's still talking about for you understanding that when we have a contract, when we issue an instrument, is it a financial asset? Is it a financial liability? Or for you to even know whether the instrument we have issued is a financial liability or equity, that's the major thing. The first one we did was to know whether it's a financial asset or financial liability. That one is simple. Nobody would really ask you that in the exam. The one they will ask you is this type that we are looking at, right? And which is the one that this 1 to 9 test for you to know whether the instrument you have issued is a financial liability or equity. That's a major thing. And if you're able to attempt these 9 questions, send it to me. I will share the solution with you. Then you would be then ready for us to move to recognition and derecognition on Saturday. Then if I'm chanced, I can schedule additional class for you guys for us to solve past questions together on IAS 19 and IFRS 2, and all those assignments I've given you can solve it together. Then a 1.5 hours class, a 1 hour class can go a long way, even if it is 2 or 3 questions we solve. Like that, we'll continue to make significant efforts, small effort until the end of the diet. this is the end of today's class. Today's class is officially closed. So again, ICANN exam is interesting if you read little by little. If you do assignments, ICANN exam is not an exam that you want to carry everything on your head when the exam is few weeks to go. You might pass, but it will just be luck. And ICANN exam is not what you read for 2-3 weeks. The likelihood of passing is just so low because there is a lot you need to have gotten used to. And the way they set questions now, they have evolved. And remember, this is a new syllabus. And they have evolved that their questions are so practical that it's not about principle or you just read and cram something. You really need to understand and know those things. That is not about you want to come and pour. No, you must be able to show that you're ready to qualify under good understanding. Of course, which is the approach I'm using to teach you guys. So try with the simple things, simple assignments, simple revisions. It's as simple as ensuring that the few things we have done today, read it before our next class. It's as simple as that. Even though there's a lot you have to read, you just have to continue to keep it simple by creating time to read most of these things. I would shut the class down for now. I think we should postpone every other thing till Saturday while you guys go ahead and revise, do my assignments, and of course, have a wonderful night. Thank you very much.
Thank you. Nice.
Thank you, sir. Good night.
Yeah.